Good evening, ladies and gentlemen. Uh, as the topic suggests, what I want to spend a little bit of time speaking to you this evening on is on what you should consider when you think about taking a family business public. And the word here, family, is, I think, of utmost importance. Some of you are founder-driven businesses who will probably evolve into family businesses over the next 10, 15 years as you think of your children coming into the business. Some of you are already family businesses, either siblings or cousins involved in the business, and you are multi-generational today. So as you consider taking your family business public, I think the considerations involved are slightly different and broader compared to a normal business. And I think it's important when you look at a listing that you don't think of it as an opportunistic matter because you want to quickly raise some money or there is a tax break that may help you for the next couple of years. All of these are considerations for sure, but when you think of it as a family business, I think it's important to take a view from a strategic perspective. Is it right for my family? So when you look at it from that perspective, I think the critical thing to think about is the longevity of your family business. So the term goes from shirt sleeves to shirt sleeves in 3 generations. Only 3 to 4% of family businesses make it beyond the 3rd generation. And this is a key consideration when you think about your business as it stands today. How do you want to ensure the longevity of your business? And when you approach a listing, I think it's critical to think of it from the point of view of longevity and what is right to ensure that my business continues more than anything else. So the challenges that family businesses face come from these 3 circles. So ownership and management exists in every company. You have an owner, you have a business and management. But the family component is what sets the family business apart. And as the family gets larger, that part of the circle becomes larger and larger. And that is what creates the additional complications for a family business compared to any other business. And I'm sure some of you are already aware of this and appreciate the nuances involved. So when you think about the challenges that family businesses face, these are very similar, across not only here in Sri Lanka, but anywhere in the world. And I'm sure some of you are grappling with these circumstances even today. So the first major challenge is the owner-manager challenge. So the first generation, the founders of the business wear a dual hat of owner and manager. But when that transcends into the 2nd and 3rd generation, you have children with varied interests who don't want to come back into the business. You have issues where the parents would always, encourage their children to come back into the business. They say there's a place for you here, and the children feel that they're under pressure to come back into the business. And the third is where children or the 2nd generation would want to run the business the same way the founder did, but face a lot of objections within the company, especially from managers who've been in the business for a while. So that's one challenge that many family businesses face, especially in transition. The second is the growth challenge. The family grows faster than the business. And this does become challenging because as it goes from siblings to cousins, suddenly you end up with fractions of a company. And if you're not involved in the business, all you get is a dividend check at the end of the year. And those dividends sometimes are not material for a lot of people. So why am I holding on to 5% of a company? It doesn't make sense. And therein starts many conflicts. Also, some branches of the family become larger than others because, it depends on the number of children you have. And then, one side of the family suddenly becomes larger in terms of the percentage holding they have versus the other. And this creates imbalances in family businesses. The third is the the business growth challenge, because if families are not willing to put money back into the business to grow, then you will not be able to compete in a market that continues to evolve. The fourth is a professionalization challenge, because in family businesses, there may be expectations that family members must come back and work, and if a spouse of one of the sons or daughters wants to come back into the business, do you allow them to work in the business? Then businesses are viewed as an extension of the family. So there are times when apartments for family members are bought through the business. These things continue to happen, and there is no divergence between what a business is and what family is. And the fifth one is the business continues to grow. It becomes a bigger and bigger part of a family's wealth. And suddenly, if tomorrow the business crashes for whatever reason, that's a huge chunk of a family's wealth which is stuck in one asset. And that creates a bigger problem as you go along. So these are the 5 reasons that family businesses sometimes struggle to make it beyond the 3rd generation. And that's why it's critical to look at whatever you are in considering an IPO. Think of this as addressing the longevity challenge that you have right now in ensuring that your family business and your legacy continues into multiple generations. So if you look at a IPO and how you consider it to be strategic as opposed to just addressing 1 or 2 things, I think you should approach an IPO from a strategic lens. And I think the IPO, as Dumit also alluded to, has many strategic benefits. Starting with attracting and retaining talent. When you have a listed company, you are more likely to attract good, top quality external talent who you can retain, who you can make part owners of the business through employee share option schemes, and so you get everybody aligned to work for the success of the business. Second, as families splinter, as shareholding becomes fractions, there will be family members who will want to exit the business, and it's not a bad thing because they have different priorities. So a listing gives a bankable value for the asset that you have. Otherwise, you have a private business, you get a dividend check at the end of the year. But if it's a listed company, it's an asset that is worth something, and it is an asset that is liquid. So tomorrow, if one of the family members wanted to exit, that option is there. Even if you don't want to exit, here's a share, here's an asset that you can actually pledge to a bank and borrow some money against it, because it has a liquid market value. So it gives you a bankable value. It also ensures that you bring in certain governance processes, which is essentially at the heart of it meant to protect minority shareholders, but it also it's there for the protection of all shareholders, to ensure that governance, especially in terms of, as you look at independent directors and all of those frameworks, it helps to ensure that you reduce the risk of the business in the long term. You also have the ability to raise capital, which is the primary purpose that a stock exchange listing serves. And it also allows you to diversify your wealth, so that this is not your only asset that you have, or it's not as big a component of your overall family wealth. So this is what an IPO allows you to do. And I think if you look at some of the successful families that have listed their companies on the exchange, you'd see this in Hemas, which when they listed in 2003, they were already a 50-year-old family business. They raised about 400 million in the company through the IPO, and they also sold down a little at the time because they wanted some funds to the family. That company, when it listed, was worth 6 billion as a market value. Today, it's worth 60 billion. That's 10 times in 18 years. The company has an ongoing ESOP scheme where they have made employees shareholders, which also has meant that they have been able to attract top talent, including the former CEO, who was also not a Sri Lankan national. Then, in terms of governance, I think it has pushed them to put some governance frameworks in place, which helps them in the long run. And the family shareholders did not subscribe for a rights issue in 2015, which actually made sure that they diversified their wealth and they've taken a strategic approach to their business. Same with Sunshine, which has increased in market capitalization, which has been able to access capital from overseas investors for their growth plans. They've been able to attract some top directors onto the board, and they've been able to attract and retain talent. So these are family businesses in Sri Lanka who have taken a strategic approach to listing and have succeeded in achieving their objectives. So if you look at the two biggest objections that I've heard for listing, the two biggest objections are, number one, I will lose control. And as the chairman said, that is not entirely accurate, and I want to kind of explain to you why. The second is, look, we are a family business, we are dynamic, and the minute you put in governance and all these, people asking questions is going to kill the business. So these are the two biggest objections that I've heard, which I want to address for you. So on the matter of ownership, there are many ways in which you can deal with it. So the first question, before I get on to this particular structure, the first question I think you need to answer for yourself is, what do I mean by control? Control can mean many things to many people, but I think in essence, control is about being able to direct the future of the company. And that could be achieved in many different forms and ways, a few of which I want to talk about today, but these are not the only options available. There may be others, and I'm sure my colleagues who will be speaking after me may also be able to add something to this. But in terms of one of the ways in which you can do it is having a family holding company or a trust, which then in turn owns the listed company, a percentage, say 51 or 75% of a listed company. And all the family shareholders sit at this private entity or private trust, which makes sure that any family member who wants to sell, while they may be able to use the value of the underlying listed company as a price, it is the family members who transact between each other. So the family, as a family unit, you always maintain control. So that's one option which I've shown here, and it also, so whatever dividends that comes from the listed company can then be deployed either given to family members or be deployed for your own wealth management or even kind of your philanthropic activities or whatever the family chooses to do. So Sunshine Holdings is one such example where this happens. Lamurep Investments, which is the family parent company, has multiple shareholders, which is of the family, and that company in turn owns 51% of the listed entity. So this is one way you retain control without too many complications. The second is to also have multiple classes of shares. So this is where you have voting shares or controlling shares on one end, and you have non-voting shares, which gives investors the economic rights but not the ability to vote at an EGM or an AGM. Now, so for instance, the extreme example I'm taking out of the US, the Ford Motor Company, the family owns only 6% of the outstanding shares, but they retain 40% of the voting rights. Now, in Sri Lanka, we have limitations around the exact extent of non-voting shares that can be issued. So it doesn't give you the same liberties as much as in certain other countries, but this option is available for you where you think about voting and non-voting shares, so you can expand your capital beyond retaining control by issuing non-voting shares. The third is brand ownership, where families choose to hold on to the name of the brand, but they let the company list, and they don't mind or care if biggest percentage of the company is owned by the public shareholders. So IKEA is a classic example of that. The family owns the IKEA brand, and there is a royalty that is paid every year based on the revenue that the company makes. IKEA is no longer owned by the family. They have a very small percentage ownership, but they continue to enjoy the benefits of it, and they continue to own the brand, so they are able to direct the company based on what they want the brand to stand for. So these are just three examples, and maybe these are not the three that are right for you, but what the message that I want to leave with you here is that there are many ways in which you can structure yourself as a family business in a way that is right for you, where you can retain control of the business without giving up without giving up the other benefits of a listing. So that's to address the matter of ownership. The second is in terms of governance. So before I again talk about what's on the slide here, the issue of governance is all about ensuring, again, longevity. As a founder of a business, the risks that you take sometimes are enormous. And you build a business to what it is today with a lot of hard work and a lot of risks that you've taken. Now from here, it is a question of how do you ensure that you increase the longevity of the business. And in order to do that, there is an element of reducing the business risk that you need to do for a family perspective to ensure that this business can continue for 3 or 4 generations. Listing is only an avenue for you to do it. It is not the reason why you do it. You should want to think about governance as a way in which you ensure that you reduce the risk of your company and ensure that it continues for a 3rd or 4th generation. And the listing just facilitates it, because it requires of you to have certain boards and certain committees and all of that. But that is something that you should want to approach as a family, saying this is what is right for me, and therefore the listing will facilitate it. But governance should also be thought of from multiple levels. One is to ensure at a family level that you have governance as well, because there are family members who are shareholders, there are family members who are not shareholders, the spouses, then you have children who are no longer not shareholders yet, but could be shareholders in the future. Everybody needs to have a say at the family table. So for that, you should have something, somewhat of a family council, which decides what you want to stand for as a family and what is it that the family expects out of the business. I think that is important, because the minute you do that, you ensure that there is a difference between the family and the business, which is important to ensure the long-term success of a business. The second is as a group of shareholders, the people who actually own the shares. Their interests are sometimes different from the rest of the family. So it's important to consider these two separately. So the shareholders of the business expect dividends. Some of them want a little more, some of them want a little less. Some of the family members are more actively involved in the business, so they would be like, I don't want to pay a big dividend this year because I have so much of growth going on. Then there'll be other shareholders who are not active in the business, whose only income is the dividend. They want a higher dividend. These are all different objectives of different family shareholders. So it's important to have a shareholder group of people who meet and agree on what the final objectives that will be communicated to the company are. And then you have the board of directors of the company, which is actually tasked with running the business, governing the business, and ensuring that the business is running smoothly and according to what the shareholders expect. And independent directors, again, something that a listing mandates for you, is something that is strategic for the business. Because at the end of the day, if you choose your independent directors right, not your friends or whatever it may be, but if you choose them right and strategically, they can all add a lot of value to ensuring that your business continues to grow and succeeds. So this process of governance does not kill the business. The process of governance ensures the longevity of your business, which is what I started with saying, this is why you should actually list. So in the process of listing, the Yusuf Ali family, which is the shareholding family of Hemas, has put this process in place, which is why, and you've seen that this company has grown from 6 billion to 60 billion in 18 years. So the company has continued to grow despite governance. And what they've done is they've put a very effective family council in place, which has anyone from the family who's over 18 years is there in that, and they have many discussions. They look after the family's education, the health, they look at philanthropy, all through the family council. And then you have the family business board, which comprises of the shareholders in the family, who all discuss and agree who are the representatives that will represent the shareholders on the board, and they ensure that whatever the priorities of the family are also communicated to the company effectively. Then you have the board of directors, which includes family members as well as independent directors who are tasked with ensuring that the company continues to grow and is held accountable for it. So these two, I hope I've done sufficiently well over the last few minutes in addressing the primary objections that many family businesses have around control and about governance, which will help you think again strategically about how you want to approach a listing. So when you think about a listing, I think it's important as a family, because it's a major transition event for the family. So don't think of it on a tactical basis. Yes, I'm going to list and raise some money. Think of it strategically, because it is going to transform the family itself. So the number one thing that you need to do is to ensure that you communicate with everybody. And I found that this is the biggest gap that families have and family businesses have, is that they are very reluctant to communicate. Fathers or mothers are reluctant to communicate with their children as to, okay, what's going to happen tomorrow when I retire? Are you going to become the head of the business? Are you not? These conversations are never had around the family table because it can be uncomfortable to do so. And a lot of family businesses shy away from having these discussions. But I think especially as you consider a listing, the number one thing is have these open and frank discussions. Because if everybody is on the same page, then the listing can succeed exponentially. So communicate is number one. Number two, I think it's important to prepare family members, shareholder directors, boards, non-shareholding family members, because everybody is going to be in the limelight. Because if you are identified with the family, when you go to a cocktail tomorrow, if you are a listed company, if someone's invested and made some money on your share, then they're all going to be happy about it. If they haven't, then they're going to ask you questions about it. And it's important, and it takes someone who might be sometimes very private into the public domain. And so it's important to prepare everybody's mindsets that from tomorrow we are going to be public, and the word public in itself means that you are going to be in the limelight. So be ready for that and prepare everyone for it. And the third is document whatever you agree on governance. Again, something I think is related to the first point I made. Families shy away from having these tough conversations and then shy away from actually writing it down. And writing it down sometimes helps. Because remember, you're thinking about not this generation, but the generation after that and the generation after that. And sometimes you think, okay, we are two siblings, we can get along, so we don't need anything documented. But remember, in 30 years' time, it won't be just the two of you. There will be your children, your siblings' children, there may be 6-7 people, then there will be their spouses. So there are many things that you should think about, and it's important to think about those and document it now. Because when you do that, then you have some basis on which you act. And I'm not saying you shouldn't change that over time, but there is a piece of paper that you can go back to, which really helps ensure the longevity of the business. And that, I think, is what the thought I want to leave with you. The IPO is a strategic tool in order for you to ensure the longevity of your business, for you to ensure that your business survives the many challenges that may comes from within, comes from the family. And I think if you think of it that way, then the IPO can be very successful. And the IPO is probably the best tool that's available for you, I believe. Maybe not the only tool, but the best tool available for you to ensure that some of these things are actually executed and facilitated. And so it can help you achieve these long-term objectives. Thank you very much.